Good morning, everybody. Thank you for joining us for the latest in a series of Deepbridge's webinars. Today, I'm delighted that we've got representatives of our trade body from one of our independent reviewers and one of my colleagues here to talk to you about EIS in general. Just a bit of an overview about Deepbridge. For those of you who aren't familiar with us, we support and invest in early stage technology and life sciences businesses utilising the Enterprise Investment Scheme and Seed Enterprise Investment Scheme. We believe in supporting, mentoring and managing investee companies with the ultimate outcome of having the best opportunities for investors and the best possible outcomes. Anything we talk about today in talking about EIS, everybody should be aware that these are unquoted illiquid stocks and therefore should be considered as high risk. Anything we talk about in terms of tax reliefs should be considered as being correct as of today, but may be subject to change. And if you bear those in mind, then we shouldn't go too far wrong today. So without further ado, I'm delighted to introduce Mark Brownridge from the Enterprise Investment Scheme Association, Lauren Radford from MJ Hudson Allenbridge, and Louise Farley from Deepbridge Capital. We'll be asking a number of questions, having a bit of a conversation. If anybody at home who's watching wants to ask any questions, please use the chat box and the questions will come through and we will try and answer those as best we can. So firstly, Mark, if I can start with you, could you just give a bit of an introduction to yourself and kind of ESA in general as our trade body and what you do?
Yeah, of course, yeah. So I'm Mark Brownridge, I'm Director General of the Enterprise Investment Scheme Association. So, yeah, very fancy title. My wife still thinks I'm something to do with the BBC because that's the only other time she's heard that title. So what do we do as an association? We do two things primarily. One is work with government and Treasury and FCA and HMRC and fun people like that to look at the legislation around EIS, how it works, how it operates, trying to make it bigger, better and more effective, essentially. And the other thing we do is events and seminars and profile raising of the scheme itself. So trying to let more founders know what it is, trying to let more investors and IFAs know what it is, and trying to bring all those two communities together and we're acting as a bit of a hub for all things EIS and SEIS.
Excellent. And Lauren, can you just briefly introduce yourself and MJ Hudson Allenbridge?
Yeah, so MJ Hudson Allenbridge, most people just know us as Allenbridge. I basically run the tax advantage side where, as you said, we do independent research. So we do all the DD and go in and deep dive and poke around the wheels and the rest of it on everything from EIS to VCTs and BR. So we've been, I think we're the longest standing. We're about 35 years that we've been doing this. So we definitely know where all the skeletons are buried.
Great, yeah, very good. And Louise, obviously you're Deepbridge, so hopefully our viewers know who Deepbridge are. But if you can just kind of give a bit of background of kind of why Deepbridge and why you joined Deepbridge.
Yeah, I mean, I've been in the finance and investments industry for nearly 20 years now. I've sat on both sides of the fence, being an entrepreneur myself, having run a fintech business about 15 years ago. And I've also worked in-house at larger PE, sort of private equity and venture capital firms. In 2011, I set up my own consultancy, and I'm very pleased to say that I worked with the majority, or certainly a significant number, of companies that are still existing in the EIS industry today, and of which Deepbridge was one of our clients. You know, when the opportunity to merge my business with Deepbridge came along, it was one of those conundrums of did I really want to give up being my own boss, but really it was the strength and the prospects of the underlying investee companies that really attracted me to wanting to do that and to join Deepbridge. And I think having the difference with Deepbridge is that the founding members and the committee have all run businesses themselves. They've all been business builders, so I think that's a real USP of Deepbridge's. Great. And 5 years on, I'm still here today.
Great, great. Okay, so let's get stuck into kind of EIS and what it's all about, I guess. I mean, last year we saw the 25th anniversary of the Enterprise Investment Scheme, so it's not a fly-by-night scheme by any stretch of the imagination. Are we seeing that EIS has it ever been in better shape? Is it in good shape at the moment? Mark, shall I start with you?
You can do, yeah. Is it in the best shape it's ever been? I'd say yes and no, if I'm honest. So, yes, in a sense that I think where we are now, investment-wise, is a fantastic place to be. And it's very clear, the government's made it very clear that we want to be investing in young, early-stage, entrepreneurial businesses. Yep. And that's where the focus is. And when we speak to government, the kind of three key words are always tech, innovation and growth. Yep. That's where they want EIS to be focused. So I think that's a good place to be. Everyone understands that. Is trying to get our messages out to IFAs and the wider community about that. So that's the other side of the fence is I think it's difficult for a lot of funds raising at the moment because the landscape has moved. So previously we've had solar renewable schemes, renewable generation schemes, and capital preservation schemes and asset-backed schemes, which have all gone. The window is shut on those now. So just trying to get the advisors and the investors out there to understand what's happening. It's a bit of a transition period, I think, in that sense. There's a bit of education for people like us and everyone else on the panel, I'm sure, to do. But I think that will come back.
Should advisors be reassured that a majority of the market now are kind of in line with what we've always called the spirit of EIS? Is that kind of a reassuring thing, Lauren? Would you say that's kind of?
Yeah, I believe so. You're always going to find managers who want to skirt the line, and as long as they're the right side of it, that's fine. But yeah, I think a lot of the changes have meant that it's been very clear for managers what they're expected to do. And like Mark said, it is about risk to capital, actually investing in growth companies which are there to help build the UK economy. So I think the government and the fund managers are very much more aligned, and we're trying to bring the investors along for that ride.
I think if you look politically, when you look back to why EIS was invented 25 years ago, as you say, it was to help companies that can't get access to finance.
Yes.
And we've pretty much gone the whole circle now. It's pretty much back to full circle.
It's gone back to its kind of
basics.
basics.
Had a liquidity crisis. The banks still won't lend to small businesses.
Yep.
This is where EIS steps in, provides funding for those companies that really need the funding.
Yeah.
Yeah, see, I think we've got a fantastic entrepreneurial ecosystem at the moment. The UK alone is attracting more VC investment than any other country in Europe right now. So it's growing year on year. So it's a fantastic opportunity for businesses looking to secure funding from a funding side of things.
Yeah. And I guess, I remember a few years ago I was at an event and one of our peers, who I won't name because that would be unprofessional in a public...
Not a live format.
I'll tell you guys afterwards. But yeah, they got up and said, this was a few years ago, we've looked at all the legislation and we think we can get away with this, which kind of goes smack in the face of kind of the spirit of EIS, etc.
Yeah.
Are we still seeing people trying to push the boundaries, or is it now that everyone's kind of gone, we know where government wants us to be investing and we need to be doing that, or is there still kind of flirting around the edges?
I think there's still some flirting around the edges because a manager's always going to try to make as much money for them and their investor, and if it means they have to be on the fringe, they might. Sure. But that's not necessarily that they're not in the spirit of the EIS. There's obviously a broad church of how far you want to go into that spirit versus that other end. But I don't think we're seeing what we used to see, like the asset back and the rest of it. We did a piece just before PCR on the media sector, and they had some managers even claiming they wouldn't give you £1 back. I think in terms of the spirit for investors, it's very much a manager is going, give us your money, we'll give it to a company and we'll make you money from it and we'll get return and these companies will grow. So I think every manager is aligned with that aspect of the spirit. There's the qualified... EIS rules are so broad and there's so many... we could spend a whole hour doing what actually is EIS qualifying. I think there's a little bit... That's where the fringes happen a little bit.
Next question.
That's where sometimes the fringing is happening. So you're not seeing... Not every EIS manager is doing carbon copy investments. That's the other thing. So there is a variety and diversity out there. So I think that maybe also goes to what not everyone's doing the exact same thing.
I think one of the best things actually that HMRC did a couple of years ago was to introduce this risk to capital condition. And yes, there are a lot of providers out there that said, but what does this mean? Define it. And effectively what it was is an HMRC sniff test. So, companies seeking to get the tax reliefs would write in and the HMRC would actually base their decision on whether they're going to grant advance assurance on what they deem to be in the spirit of EIS. So for managers and lawyers who are trying to seek definition of these, I think HMRC is very right not to actually do that, to keep within the spirit of the legislation.
So it's got flexibility around it.
Yeah, exactly.
Okay, so kind of from the advisor perspective, a lot of our viewers today will be financial advisors. If they're looking at the EIS market, how do advisors, or what's the best way of them identifying appropriate clients or suitable clients, whichever FCA parlance you want to use? Lauren, I guess in your...
Okay, so I'm definitely, hands up, not an expert in this, but I will talk more from the... Obviously, our clientele are mainly advisors, so I get a lot of conversations with them about this. One is, well, we've already said the risk to capital, there has to be the appetite and the ability to handle that risk. So that's suitability number one. The other one is, and I guess I should definitely plug the Deepbridge angle while I'm here, is
Thank you.
You definitely see advisors where their clients are entrepreneurs and they might be in a certain sector. So I had one the other day who went, they are in biotech and they want to invest in that because for suitability, they understand that market and the economics behind it. So therefore, it is more appropriate for them than maybe something that they don't know because they understand the risks. So I think they're two big things, which is make sure there's the risk to suitability, but then there's also actually what are the underlying investments and are they suitable for them? Or are they one who are literally just wanting a generalist who are quite happy to go in and see what happens and it is more of a tax planning investment profile than necessarily actually looking at it for sort of pure venture capital sort of investment.
Yeah.
I think there's three things really. There's one, suitability, as Lauren's quite rightly said. The other one's appropriateness.
Yep.
Whether the client's appropriate for this type of product. And the third one's the competency of the advisor themselves. You know,
Sure.
do you have the knowledge, do you have the experience to advise in this area and be putting clients into these type of investments? So.
And are there things that advisors can be doing on that competency kind of issue if they're wanting to do more in this area, or they think they've got clients but maybe they haven't done EIS or tax efficient investments before? Is there anything they can be doing? Mark?
Yeah, there's a lot of education guides out there. I know you guys do, and a lot of the researchers and reviewers do a lot of guides around EIS and how it works and operates. Nice segue, nice plug, thank you very much, because I'll take it. The EIS Association do our own accreditation, so you can...
It's almost like I lined that up for you.
You can see how these things work, right? So we do an accreditation whereby advisors can come on. It's pretty much a one-stop shop for everything you need to know about EIS, and it gives you some qualification, CPD qualification as well. So.
Great.
I mean, I'll just add to that actually, sort of going out and speaking to advisors. Obviously, they're not telling their clients to invest their entire investable wealth into EIS. Quite often, the sort of allocation that they might put into the alternatives might just be 10%. Yep. But I'm telling you now, the conversations that I have with advisors and why EIS is such an exciting opportunity is because, you know, really, I mean, you're an ex-advisor, Mark, you know, how many of your clients used to pick individual stocks within their pensions to quiz you about?
Yeah,
it was probably just a portfolio. Yeah. But the individual companies in an EIS, and especially in the life sciences and tech sector where we work, you know, you do have a bit more of an emotive sort of driver behind it. That really is what gets conversations moving, and it's a definitely selling point for an advisor to be skilled up and to be actually using EIS as part of their tax planning for clients.
It's quite interesting. I had an advisor the other week who described it to me as the interesting bit of their annual review.
Yeah.
They go through the pension, they go through the ISAs, everything's great.
Let's get to that 10% bit.
What's X company doing and how they're getting on it.
You'd be surprised about how many, it's an easy way to get into venture capital at a lower price point for people who are not going to be angel investors and the rest of it. It's a nice way to dabble. And also, I'm guessing we've all had these conversations where people, like you said, get excited because it's a good dinner party conversation going,
definitely.
I'm invested in this particular investee company, which EIS, because you're directly invested in the company, it's even more of a sort of benefit. So you have the ones like, oh yeah, that's my company, that's what I do. Or like it gets in the news, you're like, oh yes, I'd look, but they love it. Let's face it, it's a sort of a value add for this sort of tax wrapper as well.
Yeah.
Well, yeah, it's a good point about the tax as well, because I think it kind of gets lost sometimes, the investment story, because it's got 5 tax reliefs and one of the most tax advantage schemes in the world, you concentrate so much on that, what you can do as an advisor, you're doing your tax planning and your financial planning, which obviously is very important, but you forget actually there's some really interesting, exciting stories in EIS land, so that, you know, there's companies curing cancer, there's companies doing power for good type things, to have power, people trying to empower female entrepreneurs, etc., etc. So really trying to invest
plug as well there, Mark. I mean, like, we can't say anything yet.
I should have said that.
But I think it's things as well. I mean, I think we do regular events around the country, which we call Meet the Company events, where we get a couple of invested companies along for people to actually kind of see the whites of the eyes of CEOs of these companies, the founders, just as examples of the kinds of companies we invest in. And often we try and get local companies along. So, you know, a couple of years ago we did an event in Glasgow, and we were sat in a room, 2 companies there, and the 2 companies were presenting were both based within 100 yards of the room we were in, and created over 70 jobs locally. You know, and those kind of things, and people kind of get it, and it's actually more than just the tax planning, they're buying that kind of...
I think that's a point of difference with unit trust funds and WAIC funds and portfolio funds. You don't get to meet those companies. So the fact that through EIS you can meet the person you're actually going to give your money to, who's going to try to invest your money in their company and hopefully give you a significant return at some point. But you can actually meet those guys and girls and get to know them.
That personal buy-in, I guess.
Yeah, exactly. Yeah, that's what it's all about.
So, I was going to say, I guess that also the geographical one is like you definitely have. It's not as London focused. We have like yourselves, you're not just in London. You have like from the Isle of Man to London to the Isle of Wight, everywhere else. It's one of those things where it is very much reaching companies and investors across the UK, and that's what it was meant for.
Absolutely. In terms of kind of just going back to what you touched on before about the risk capital condition, the patient capital review, etc., I think one of the key terms to come out of that was knowledge-intensive companies. Lou, do you want to just kind of briefly just explain in very layman's terms what a knowledge-intensive company looks like, or what it is, or anybody else wants to chip in? Or?
Yeah, I mean, you know, and the government made the decision to increase, I mean, for an investor, basically, you can put in more money into knowledge-intensive companies. For anyone looking to put in what was the max of $1 million into EIS, you can now put in $2 million, and I'd love to speak to you if you have any of those clients. But with the actual, what it means to the actual companies themselves. It's different conditions, such as we used to be sort of capped at a company that might have been older than 7 years, but now with knowledge intensive that can be up to 10 years. It could be a greater scope and more broad. So really it's what Deepbridge has always done though.
Yep.
So it's just a further sort of tip to the cap in what we've always done. And actually we did a review across our whole entire portfolio, and I think bar one little outlier in there, everything qualifies as knowledge intensive. So we're working
Lauren
with the
and
government
Mark,
in that.
are you seeing that more money is going into knowledge-intensive companies as a result of the patient capital review and the changes, or kind of anecdotally, if not statistically backed up?
Oh yeah, definitely not statistically. But to be fair, on Louise's point, a lot of EIS companies were basically hitting that qualification anyway.
Yep.
So it gives investors more freedom, and also investors who want to add more. It's more that. There is a few knowledge-intensive focused funds, but I think it's more, like you said, it's a bolster to an existing portfolio from many managers. And I don't think there's necessarily, it caused more money to necessarily come in, but I think for the ones who were already in, it maybe gave them the ability to invest more versus it triggered more investors to suddenly look at EIS for the first time.
Sure, okay. And Mark, have you kind of seen anything around the knowledge-intensive kind of world?
Yeah, the knowledge-intensive one's a bit of a curate's egg, really, I think, because when we speak to government again, the point of the fund is that they want to raise an extra £6 billion to help knowledge-intensive, which generally means kind of research-based, R&D type development type businesses. I guess your classic is, and you guys probably know better than I do, a medtech company who obviously is going to need a lot of money to get started, number one, but it's also going to take quite a long time to come through to revenue and then profit. So it's difficult for investors to invest in those companies at an early stage because they're not going to see a return perhaps for some time. So the government wants to try and encourage that, and therefore offers more reliefs and more limits,
In fact,
etc.
certainly in life sciences, it's got one of the strongest R&D facilities in the UK, and the government in December sort of launched its pledge to put £1 billion into that alone. So that again further is sort of testament to what we do at Deepbridge, but backing
and same
up
with this fund. I
point
think they're trying to raise an extra £6 billion of funding for these type of businesses. But at the same time, those type of businesses are difficult to fund, difficult to get into. And also, it's £6 billion of new money. It's kind of a new money magic tree, if you like. So it's not money that's already in EIS or VCT, it's money from outside of that. So I think it'll be a difficult one because most advisors have been used to capitalisation, asset-backed, lower, perceived at least, risk type EISs. But now we're asking them to go kind of super high growth, perhaps higher risk EIS as well. So it's just trying to get, again, those messages across to advisors about what's happening, why you want to invest in these type of businesses, and just trying to set their expectation levels, really.
And I guess there's been some high-profile, lower-risk EISs which have proven not to be low risk at all, and exactly as EIS should always be treated as high risk. And I guess that kind of supports the kind of the knowledge-intensive. Actually, if you're going to go into an EIS, go into a diversified portfolio, because you will have winners and losers within that portfolio. I guess is that a fair assumption, Lou?
Yeah, I mean, ultimately, you can't put all your eggs in one basket. As an advisor, they're going to be diversifying. With Deepbridge ourselves, we although we're specialists just in life sciences and tech and our EIS side of things, there is an enormous amount of subsectors within each of those alone. So, by virtue of the fact that you're coming into a specialist portfolio, there is still a level of diversification within that. But any advisor really, should be looking at a spread of probably at least 3 different providers for a client in order to, mitigate the risks there of investing.
We've had a question from one of our viewers, directed at you, Louise, which is great. Just a very kind of top level, what kind of due diligence does Deepbridge do when we're looking at investee companies, or just just a few key kind of things we look for in investee companies, I guess.
Yeah. Oh, it is rigorous, I tell you. I mean, first of all, I'll just sort of touch on the sort of sources of where we get these businesses to come in from. We work very closely with tech transfer offices, unis. We have a huge supervisory committee that will bring in businesses. We've got a good reputation while we attract sort of proprietary deal flow. And once we get that knock on the door from a company looking to partner with us, we do have sort of an initial fact find. If it matches our criteria is generally it's got to be IP driven, it's got to be globally scalable, it's got to have the opportunity to operate in multiple verticals, it's got to have an energetic team. I think fundamental and foremost, we're going to be working with these companies anywhere from 4 to 7 years, depending if it's more on the medical side, more on the tech side. So we want to be sure that we're going to be able to work with these companies and help grow and scale. so once we sort of balanced off the criteria, we don't just make a decision there. We will visit them where they're based, and that will probably be a numerous amount of times as well. We get them to come and see us as well, make sure it's a good fit all round. And we do what most providers and what you expect from providers by looking at, it's all very well to kind of look at figures and numbers and projections, but when you're dealing with early stage businesses, you have to have the skill set of knowing that things aren't always going to go according to plan. So when the patient capital review came in, this idea of being patient with your money and further supporting the growth and development of that business to make sure they don't run dry of money, that's what we do when we have our evergreen sort of nature of our portfolio anyway. So yeah, we have quite a lengthy process. Plus we also have an external due diligence committee on top of our own internal one, so we get sort of double checked on everything that we're doing and our assumptions tested for us.
And how many companies do you see every year, and how many do you actually invest into? Sorry, I'm stealing your question.
That's a mean statistic to
I
ask.
think in 2019 across tech and life sciences, we probably see about 1,200, 1,300.
Yeah.
And I think we invested in new investments last year, probably 20.
Yeah.
Yeah.
Do you see the 1,200, or they approach?
We'll be
I was gonna
approached.
say that-
We'll do. That's where we've done some sort
So
of
desktop
basic due
research.
diligence on them,
Okay.
etc.
Otherwise, you guys barely breathe then.
But I guess from an advisor's perspective as well, for you, Lauren, in terms of we are thoroughly vetted as managers in the market, from the likes of Bridge and others. Kind of what is the key things that the likes of yourselves look for, or kind of try and monitor, or try and kind of review when you're looking at managers?
So if we are asking transparency from you, we do the same. So we do actually have a nice 54-page methodology, which goes into, basically we have 10 factors that we look at. So there's manager, and I guess a big sort of selling point for us versus some of the other providers is we also look at the business and manager stability and governance, when governance is becoming a big sort of focus nowadays, especially after stuff that's happened. And then on the product side, there is questions like on investment process. So actually, like, what DD do you do? And then what is your actual investment strategy? What is the market opportunities there? And then I guess the big one in this sort of space, what is also the risk management? Because all EISs are risky, but managers who are good will be able to mitigate and manage that risk. Then performance, obviously past performance is not an indicator of future performance, disclaimer, is always there, but it's always good to show that sort of track record. And then obviously fees. And so our reports are normally running to about 25 to 30 pages. A manager does not look that nice after they've come out of a 3-hour DD meeting with us. So it's research needs to be done, and like I said, we've been doing this for 35 years, and we also will do it on an annual basis, so we can see what you said last year and where you are this year, and it's that continuous monitoring to see what you're doing, and we say what you guys are doing well and where things you need to consider, and there's no perfect manager or perfect product, so it's doing your DD, and it's just a good place to go start reading the reports and figure out maybe what questions they need to ask you guys directly.
Maybe I'm sad, but I actually quite enjoy those meetings. But anyway. Okay, great. And Mark, kind of trends or anything you're seeing in the EIS market at the moment? Are there kind of any major trends that you're seeing, kind of new entrants to the market, or kind of any changes that are going on?
Yeah, certainly lots of new entrants. The sector seems to be really popular at the moment. I think, interestingly, can find both ends of the scale as well. So a lot of early stage, want to be first in money type PE houses and VC houses are starting EIS funds or SEIS funds. And at the other end of the scale, a lot of retail kind of A-series funds coming down the scale as well. So I think most of them want to have a fund that's appropriate for each stage of a company's journey. So all the way from seed going through to institutional.
And are you seeing people that are sector specific, or still an appetite for generalists in the market? I mean, as Louis said, we are tech and life sciences, but is that kind of the norm, or is that unusual these days, or is it?
I think it's more of a sector specific focus these days. Particularly tech. Anything with tech in the name seems to be popular. But it's just nice to see proper venture capitalists coming into this market and setting up a fund, rather than someone just thinking, oh, there's some money in that fund, in that sector, let's get into that sector and try and raise some. So we've got proper entrepreneurs setting up proper venture capital funds and trying to put money into proper companies. And
so I think certainly when we started out in the EIS space 5-6 years ago, it was, we would do events alongside other EIS managers, and we were the only ones talking about growth. We were the only ones talking about tech. We were the only ones talking, quite openly about where money was likely to be going, etc. And I think from our perspective, I think it's quite reassuring and refreshing that actually most people are now, the market's moved that way with us, and I think that's hugely positive for advisors and clients alike.
Absolutely,
I guess talking about kind of reviewing kind of what goes on in the market, I guess transparency is one thing we talk about. One of the things that we often get asked about is kind of how, because we charge investee company fees, not the investor, but other companies provide they charge the investor, etc. There's various different things. Is kind of the fees transparency, is it there in the market first of all, and secondly, is it comparing apples and pears sometimes? I don't know, Lauren, I guess you're probably the
I
best
guess it's
person to tell us.
the proverbial banana skin no one wants to sort of fall on. But no, so I would definitely rephrase the question in a certain extent, because there is fee transparency and then there's fee comparison.
Sure.
So fee comparison is a little bit like apples and pears, because like you said, there is a reason why some people charge investee companies versus others.
Yep.
And in fact, it goes to Mark's point that you have some who are doing later stage investments alongside big VCs, and they can't, to be competitive in that space, they can't charge the investee company.
Sure.
And then you have others who might have more proprietary deal flow, who it makes sense to increase tax eligibility to do it that way. The bigger thing, and to be fair, the bit we're trying to focus on is there is still a massive lack of fee transparency and confusion for investors, because I can tell you now, when we can have the same fee basically called 3 different things by 3 different managers and structured 3 different ways. So if we are getting confused, it must be hard for advisors. So I think the big thing is actually looking at value for money, because that's the other thing. You can have some managers who might charge more, but it also could be because they're providing a lot more services to the investee companies. Their value add is acting directors and networks, and then you have others who are a lot more arm's length, and it makes no sense to maybe have a massive AMC on that one versus one who's doing a lot of.
Sure.
So it's going, okay, let's actually look at the risk return profile, going, if I give you £1, you charge, £10, and then you go, but you're going to give me 200. I'm going to take that one versus one who necessarily charges me £6 and is only going to give me 150. So it's looking at the value for money and the risk return profile, I think.
Passive versus active, I guess.
Absolutely agree with this. Even when we're talking to investee companies, I always say to them, you've got 3 types of money. You've basically got your clever and smart money, you've got dumb money, and you've got any money. Deepbridge certainly sits in the clever money. We've got the skills and the expertise, so we're not just looking ever to invest capital into a business. It's our skill set that we're doing to help grow and scale those businesses.
And to be fair, I will be honest, there's a lot in this space who do charge a lot. And sometimes it is because they can, because this space is not as transparent on fees. So there is a lack of incomplete knowledge for investors, so they sort of go, okay, well, they're going to make me money, I should just take it, and they don't know where these fees are being taken out either. But there are others who really do give good returns and charge the right amount of fees. It's also hard for investors because they're looking at like an ISO or an institutional, and they go, well, it's really easy there, it's a 2 and 2. Like, it's a lot. This space is a lot more complex, and I guess that's where as a sort of industry, it gets a bit of a bad rep in terms of fees because of the transparency or just the complexity of knowing what's actually being charged versus the amount necessarily.
So I think sometimes you're spot on. Sometimes it is complexity rather than lack of transparency, and I think that's where the confusion sometimes lies.
I think from an advisor's point of view, certainly on the complexity point, if I or probably my client is investing £100,000, I just want to know how much is going to come off in charges. Am I actually going to invest £92,000 in that company or that fund? Is it 96? Is it 97?
What's your tax relief going to be as well?
Exactly. That's kind of on top as well. Absolutely. So just want to know how much has gone in, then you can work out further on how much has gone down, how much comes out, so you know what your return is.
Absolutely.
So just trying to make it as simple and trying to boil it down to that. But that's a bit of a minefield to do. So we're trying to do some work at the moment with fund managers and reviewers, etc., trying to get a kind of a guide to fees and how advisors can look at them. As you say, it's difficult.
Interpret them, I guess, in a sense.
Well, just know what questions to ask sometimes. That's sometimes even just asking, do you charge fees at the investee company level? Because most advisors wouldn't know that that's a way to structure it. And it's like, oh yeah, fine, we do. This is what we do, and this is the reason why. And that's fine.
Yeah, I think sometimes understanding the provider's kind of background or raison d'etre, kind of why are they doing that, and why do they do it that way? Sometimes that answers some of the questions as well as just kind of blank paper. Kind of talking about kind of advisors looking at the market, etc. Obviously, there's independent reviews in the market. Kind of what kind of support is there out there for advisors looking at this market, particularly if they're looking at it for the first time? I guess, Mark, shall I start with you, kind of, because Lauren will no doubt...
This is the one where you've lead me up for my plug,
But Mark kind of started, and then I'll ask Lauren following up from that.
So in terms of getting into the market, again, there's a lot of guides out there, there's a lot of education. Most EIS providers, certainly that I know, are pretty hot on getting guides out to advisors, and letting them answer any questions that they need answering. So they're really good. So obviously, again, plug for ourselves, but we have our own website. We have a lot of information on there, so go on to there. Just try and get to as many events as possible as you can to try and get some of the answers that you need. Obviously, there's reviewers out there, yourselves and MyCap and Martin Churchill, etc. So they do some really good work. I think particularly with research and due diligence and that kind of area, if you can take what people like Alan Bridge and MyCap and Martin Churchill do and add that to your own internal processes and work out what you want from this sector and what you want for your clients, more importantly, that's probably a good starting point.
Yeah, I think for a lot of advisors, the first step is they will look at independent review, but I think they've then got to build their own research off the back of that, and I think that's kind of what you kind of encourage as well, I guess.
Yeah, because we're obviously ours is based on reviewing you. We don't know the client, so that's also where the advisor has its value add for the client and knowing exactly what it wants. Because it could be, as a report, we say Deepbridge is brilliant, and when they have another one which is in the luxury goods market, and it might just be that one's better suited for that client than the other. So it's definitely come to us, so you don't have to do all the legwork, basically, or other advisors or like Intelligent Partnership do roadshows, so you can go one place, see one things. But yeah, we have a website where you can subscribe, go in, see the 50-something plus EISs, filter by basic things, and then let me read the report and go, yeah, that's for me, that's not for me, or these are the 3 I should probably go to events for or ask more questions. But at least it's someone who's got expertise doing that original DD and helping you figure out where the skeletons are or where the things you need to poke and see if it's painful. That sort of mentality.
Sure. And I guess kind of leading on from that, Louise, I guess what are the kind of 3 key questions in your mind that advisors should be asking providers such as ourselves?
Okay, so we're
pretty much
in March now, so thank you to you advisors are actually taking the time as we're coming up to the end of the tax year to watch this. But right now, I think it has to be to do with sort of speed of deployment, especially for any investors looking to carry back a tax liability. That key date of getting it invested by tax year end is very important, and it's of course something that Deepbridge does do.
And we have a filter for it on our website. There you go.
There you
Double
go.
plug.
What kind of ties into that as well is like, great, you've got the money invested, you've done it in the tax year that I need you to. Now when am I going to get the certificates? So there's sort of various conditions that have to be met in order for a company to be able to apply for these. Every company that we have in our 2 EIS propositions, they've all gone past their 4 months minimum trading. They've all spent the sort of 70% cash that they need to. So we typically deploy, the last working day of every month in the run up to tax year end. I think the accounting teams are frantic, sort of doing weekly deployments. But as soon as we make those deployments, the companies then, write to HMRC with their EIS ones to then get the certificates back, and it's typically taking between, I think it's about 6 to 12 weeks with HMRC at the moment. But that, compared to some other providers that might sort of do a fund close and then have a year's grace to sort of find the companies and then deploy the money, you've got that extra lag on when you're actually going to get the certificates.
You've got to build that into your planning, I guess, isn't it?
Exactly. And again, really on transparency of the companies, it's all very well talking about, historic performance and what we've done in the past. But, if an advisor says to me, I'm seeing a client tomorrow, what would they likely be invested in, by the end of the month? I can tell them. I know what companies are open within our portfolios and just give them a quick summary. So when they are having that meeting with the clients, they can just literally have a one-liner and say, this is the kind of thing that your money is likely to get invested in. And that seems to go down really well. And I think we're fairly unique in our ability to do that as well.
So
I was going to add, there's another one, just because EIS and its goes to the tax relief has loss relief. The one thing I would suggest you ask as managers is, this is, as much you're in individual companies, most of these sort of schemes are portfolios. So very much look at it at a portfolio level. So we know most VCs are going to have losses. So go, okay, you're spreading me across 5. What do you need to do to get my client the return they're looking for? And have that conversation, because you're the advisor who's going to have the conversation with the client going, yeah, 2 of them failed, but don't worry, on an overall portfolio basis, this is what we expect to happen also in the time period. So that's the thing, know how long you're going to be invested in, because some houses, depending on their strategy, could be looking more towards the 4 to 7, and there's others which are the 8 to 10, and the risk return profile will vary depending on which one you are. but it's the liquidity aspect of EIS that you need to very much also be mindful of when putting a client's money in it.
And I'm guessing losses tend to come before successes. Is that fair for
Not
most
always,
portfolios?
but yeah, you've got the ones which will it just didn't work, or the money wasn't able to make the difference. So yeah, they will go, and you can always have ones that, Brexit happens or whatever else happens and it just didn't work and they can't adapt. So yeah, it's always the way, and it's also doesn't necessarily also mean that the big ones come later either. You can also get some early door exits, which sometimes means a loss of tax relief, which is not good, but normally it's enough of a check to make it. It's normally enough of a check. 29 times, I'm pretty sure I'll take the 30p back again.
That's a good point though, because it comes back to risk. I've just reading the book we are by Daniel Kahneman about risk. He talks about this quite a lot. The fact that in EIS world in particular, the lemons ripen before the plums, as they say. But there's a kind of investor mentality there as well, because you'll see investors will rather see less of a loss than more of a gain. So when they're seeing early losses, that makes them think, wow, I don't want to do this anymore. This is hard for me to take. This is unacceptable. And then they obviously perhaps won't invest in EIS again. But you kind of have to ride it out a little bit. And I think that's where it comes back to setting expectations for an advisor to say, look, if you're going to go to a portfolio of 10, 12 companies, I'll be honest with you, 4 or 5 are going to go bust. 2 or 3 are going to bumble along. But hopefully those 2 or 3 will go super stellar, and that's where your returns will come. And that's why we have diversification in the first place. So it's really key, I think, for advisors to set that out early on.
Okay, that's great. So I think that's really useful for advisors to look at. I guess kind of looking at going back to the market as a whole, obviously there's been change over the last few years. We've got effectively a relatively new government in now in terms of some similar personalities and individuals.
New chancellor, at least.
Exactly. We've got obviously a budget coming up in the next couple of weeks. Is there anything you're thinking might come along in terms of the EIS market in the budget, or is there anything you'd like to see in future budgets? Mark, I guess start with you as you're closest to Westminster.
Physically. We're all quite close at the moment.
So I think it's a little bit early to ask for kind of changes and things we'd like to see. Obviously, most of the EIS stuff that we don't like is EU state aid related. Because some of the EIS rules are under EU state aid rules. And we're a bit early in the negotiation process to perhaps be asking to change that. We're certainly lobbying to do that, to get our key messages across, because as you say, I think it's a good time for us to be doing that. We've got a new chancellor in, we've got a new government in, we've got a government with a majority in. And obviously Brexit has kind of almost happened. So we're kind of on the road towards that. So we'll be lobbying for things further down the line, changes in limits, changes in some of the rules and legislation. But at the moment, not really expecting too much for this particular budget.
Lauren, anything from yourself on?
No, the only thing I would say is obviously, luckily, EIS has literally been named by the government, so we don't think anything major is going to happen. I guess it's more the stuff around it. So we expect there might be stuff to tinker with pensions, which sometimes is actually why investors look at this space, because it's a good alternative. So if you can't put stuff in your pension, to look at this if you're young enough to get some growth. Entrepreneur relief as well, we think might go, because the budget needs to find money from somewhere. So, but they're the only things that really, I think, have had any sort of rumours about.
Kind of any
But nothing. I don't think we're not having another patient capital review. Let's put it that way. So IHT maybe, but. Whether it's the radical, like it's flattened and it goes to 10%, I'm not sure with a new chance the rest of it that it might not be this time around. I feel like that might happen. The next one, I feel like we might have another tinkering along the edges.
Consultation.
Exactly. We might eventually get the approved knowledge and to approve fund.
I guess that's the only thing that might come out, that they might actually finally
give some clarity.
I think as I understand, they're going to ratify it, and then over the summer it'll be in the finance bill and be ready to go for.
Okay, well, we're coming towards the end of today, so I've just got a couple more quick questions, kind of more general kind of things. I mean, I think one of the things that I've got over the last few years working in this space is that actually most of our peers, everyone we kind of work with, is genuinely excited to be in this market. Working with VCs, working with early stage companies. Kind of what are the kind of exciting things that kind of make you kind of get up in the morning to come and do what we do? I mean, Louise, starting with you, I guess.
It's the variety of the companies that we see. We've got a portfolio now. I think it's like 160 companies. And seeing as we're specialists, that's an awful lot of companies. But I probably get inquiries from 4 companies a day looking for investment, and that could be anything from kind of sports tech side of thing, to the femtech sort of. I'm looking at sort of menopause and things like this at the moment. But it really is exciting. So sort of no matter what's going on in your day job, to actually see what other people are working on, innovative investment. That's always been our strapline for as long as we've been going, and truly the companies that we're seeing and backing are so innovative. I can't even believe, as a specialist, some of the stuff that's coming out to market and being invented or created, or just carving new ways. So that's what gets me excited.
And Lauren, from your perspective, being involved in this world?
To be fair, it's more, it's the people. So you do see people who are very smart and engaged, and everyone, like you said, enjoys what they're doing, and that's slightly infectious. And it is always moving. So we've had patient capital, but even then you see new entrants who are looking at different types of deals, different types of structures, or investors who are looking at this for the first time. So you're meeting new people, and I think and hearing their ideas and sharing that sort of knowledge exchange is, to be fair, one of the reasons I get quite excited. It's when you've had very intelligent conversation, whether it's over coffee or wine. Sometimes you can very much help you get through a day.
Quite a lot of wine now.
To be fair, that's true. It's finance.
Do you know what, just to sort of add really, EIS as it stands, I mean, I know sometimes people can get down on it, but it's one of the most enviable tax solutions globally.
In the world, absolutely.
We have got a number of businesses that we have backed that have originally come from Australia, so we've got an office out there to bring us deal flow. I think we've got something like 7 or 8 different companies now. These are people that are willing to relocate their families, their lives, their jobs to the UK in order, one, to work with Deepbridge, but also to access that kind of EIS money.
Not the lure of Chester. But no, it's true. And to be fair, Louise, I think, mentioned it earlier, the UK is a massive hub for VC money. And it's the biggest thing in Europe. And when the last few years of Brexit, it's not been diminished, it's been increasing. And with the EIS rules and the rest of it, we're very much building up and rivaling America for that sort of scale-up fund and the rest of it. And you're having companies who are coming and go, let's start here, and then use this as a base to go and get expansion capital into America and other things, and rivaling Silicon Valley. So I think that's the other thing. You're seeing interesting founders and investors. It's every aspect of the change. You're seeing interesting people and hearing new things.
And Mark, I guess from your perspective, you kind of came from the IFA background into the EIS world. So kind of, so you must have found a particular interest in this market when you're looking at it from that side of.
I think so. I always say that I don't think EIS should stand for Enterprise Investment Scheme. It should stand for Economy, Investors and Start and Scale-Ups, because that's pretty much what the scheme's all about.
I like that.
You can have that.
I'll take that one. We'll take it.
That's the 3 areas that mainly benefit from EIS. So the economy, in terms of the significant contribution that EIS makes to the UK economy. So we reckon for every £1 that goes into EIS, the government gets about £4 back in revenue. So kind of they're happy. Investors, they get the tax release, they can invest through the scheme. It makes it easier to invest. It's de-risking. It's not taking away the risk, but it's de-risking. So it helps them. Obviously, hopefully they get some significant returns as well. And then finally, as the ladies have said, it's start and scale ups. That's what it's all about, right? It's hearing those journeys and those stories of those companies that have started really small with, one person in their bedroom taking in 50 grand from their friends and family and going all the way up to being a super company. People like TransferWise and Brewdog, they're all companies that started small through EIS in a geographical location in the UK that have gone on to be really super global companies all through the scheme. So it's hearing those stories and being part of those stories then.
Great, we've got a few seconds left, so I'm just going to ask you each just to give kind of our viewers kind of one takeaway about kind of why they should be utilising EIS, or kind of any bit of advice that you've kind of got to give them. Louise, can I start with you for that?
Don't think that it's not worth it. We know that there's a lot of due diligence that has to be done before you can do your appropriateness test and your suitability for clients. But genuinely, the type of businesses that we're investing in an early stage will help you build rapport with your clients. Not just looking at a portfolio return on a pension, actually looking at the underlying companies will get more engagement. I'm seeing it not just with IFAs, but also now into their children are now taking an interest in wanting to do good with their money. Certainly things like ESG and stuff like this is becoming, very big and part of what we're doing.
Lauren, have you kind of got a takeaway?
I'm going to do a plug, so make sure you do your DD or let someone else do it for you, because it is risky, and that's normally what put advisors off. But it is not as risky. As much as they're all high risk, you can also manage that by educating yourself, reading up, asking managers. So I think it's do your research, but then trust the EIS really and also the process, and know that you'll get good investments at the end of it.
And Mark, kind of last word from yourself?
Yeah, so probably the D word for me, diversify. I know advisors talk a lot about diversification across their portfolios, but nowhere is it more important than probably in EIS land. So yeah, get out there, speak to as many fund managers as you can. They're all doing different things in different ways, in different sectors, with different fee structures, as we talked about already. But it's really key that you can find different ones and have that relationship with them, because it's all too easy at this time of year, particularly when you're busy and you've got pensions to look at and ISAs, and that's probably a more core part of your business, just to stick to the big established players or someone you know at the EIS company.
Thank you very much.
Well worth your while speaking to them.
Excellent. Well, thank you very much, Mark. And thank you very much to everyone who's joined us today. And we will look forward to seeing you on future webinars. So thank you for joining us. Thank you very much, everybody. Thank you for joining us. That was, hopefully that was a conversation.